We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
If there's a universal investment ideal, it's that every investor wants to buy low and sell high. Rebalancing does just that. And in today's episode, I'm going to explain rebalancing at a high level with some simple examples, point out some of the practical challenges for rebalancing, and then talk about the very best way to rebalance your portfolio. So let's dive in. Imagine you've just created a new portfolio with a specific mix of stocks and bonds based on a personalized financial plan. The portfolio naturally will look as you designed it on day one, but then naturally markets shift around and your investments drift from their original allocations. So consequently, you're no longer invested according to plan, even if you've done nothing at all. If stocks outperform bonds, you end up with too many stocks relative to the bonds, and then you're taking on more risk than you originally intended. It's not like the starting allocations are some perfect portfolio that has to remain precisely on point, but as your portfolio drifts further from its intended target, your portfolio is going to need some attention. Rebalancing takes advantage of this trend by selling asset classes that have done well and buying those that have done poorly. In other words, rebalancing ensures that you buy low and sell high. In the current example of stocks outperforming bonds, to rebalance your portfolio, you can sell some of the now overweight stocks and use the proceeds to buy bonds that have become underrepresented until you're back at or maybe near your desired mix. If you're regularly adding to your portfolio, whether it's on a quarterly or monthly or annual basis, or even an ad hoc basis, another strategy is to use any new money you're adding to the portfolio to buy more of whatever is underweight at the time. And either way, think about what's happening. Not only are you keeping your portfolio's risk and return levels aligned with your goals, but you're buying low, you're buying those underweight holdings, and selling high, the overweight holdings. Better yet, the trades are not a matter of random guesswork or emotional reactions. The feat's accomplished according to your carefully crafted, customized plan. Now let's look at how this works with a simple example using historical data. There's a table in my book that shows annual returns for the various asset classes dating back to 2000, and I'll make sure to add that to the show notes because it's going to be hard to describe that purely with words. They do say a picture's worth 1,000 words for a reason. This table is often referred to as the periodic table of returns, mostly because there's a lot of returns shown in little squares, although sort of a tangent, but Phil Huber created something on his blog, Bips and Pieces, that I'll definitely link to in the show notes that's more periodic table-like, but that's really besides the point. If I'm going to stay focused here, if you do go to the show notes at thelongterminvestor.com, you're going to see periods of higher returns for any given asset class are often followed by periods of lower returns. And in the book, I compare the outcomes of an annually rebalanced portfolio versus a portfolio that's never rebalanced. And when I'm looking sort of at that systematic selling of asset classes that have done well and buying those that have done poorly, the annually rebalanced portfolio ends up with more money. I look at the growth of a dollar from 2000 through 2017, and the annually rebalanced portfolio grows to $3.05. The portfolio that's never rebalanced grows to $2.86. Now, this is interesting because the annualized total return is actually a touch lower for the annually rebalanced portfolio. It's 6.4% for the rebalanced portfolio and 6.6% for the portfolio that's never rebalanced. But the annualized standard deviation, which is a measure of volatility, is lower for that rebalanced portfolio. It's 10.8% versus 11%. And all else equal, if we had two portfolios with identical returns, the one with lower volatility is going to compound at a better rate, such that you will have more money at the end of the period. And that's why that growth of a dollar is better for the annually rebalanced portfolio example that I give in my book. Again, the graphics and the tables, I'm going to put them on the show notes at thelongterminvestor.com. The other thing you'll notice is really that the worst periods for this annually rebalanced portfolio weren't quite as bad as the portfolio that was never rebalanced. The worst one-year return I'm looking at it, annually balanced portfolio was negative 32%. The never rebalanced portfolio was negative 33.3%. Or the lowest annualized three-year return for the rebalanced portfolio is negative 9.2% versus negative 9.8% for the never rebalanced portfolio. Now, there's no guarantee that rebalancing is going to enhance performance, but the biggest benefit of rebalancing is keeping your risk exposure in line with your risk tolerance. So if you set out to invest in a portfolio with 70% stocks because it meets your needs, then you don't want that portfolio to drift to 80% stocks as a result of the rising stock market and ultimately become a riskier portfolio than you're willing or able to tolerate. Now, this is a pretty plain and simple example, but in real life, rebalancing can be more complicated. For starters, my example uses a relatively simple index portfolio with a single account. But in my experience, most investors don't use that type of an approach. To be clear, there's absolutely nothing wrong with a pure index strategy. In fact, it's one of the 3 evidence-based investing strategies we use with PlanCorp clients. But as I like to say, there's no single portfolio that is right for everyone. And an all-index approach, in my opinion, is easily among the optimal options for a lot of people. But with that said, most people don't use an index strategy. Maybe that's because people are looking for strategies that have an opportunity to beat the market, or maybe they look at the index portfolio and think it's too simple. I don't really know, but it's not the most common thing that you see. But anyways, you more often see people with multiple subcategories within the different asset classes, which introduces more positions. So in my rebalancing scenario, there was an index fund representing each asset class, whereas in reality, I tend to see people have portfolios with multiple funds in each asset class, going deeper into these sub-asset class categories, and then sometimes even having 2 or 3 funds representing one specific exposure or one bucket within the asset allocation. The other thing that is very common is that people have more than one account, and their holdings aren't divided such that they're the same positions in each of the different accounts in the same percentages. And even if that were possible, it's probably not an ideal asset location strategy for generating the highest after-tax returns. So the tendency for investors to have more positions across more accounts than my example means that there's going to be more trade-offs in the real-life implementation of rebalancing. But before diving into those trade-offs, I also think we have to make note of the behavioral side of things, because like many things with investing, implementing in real time is much harder than talking about it theoretically. With rebalancing, it can be very scary to do in real time. Everyone understands the logic of buying low and selling high, but when it's time to rebalance, your emotions make it easier said than done. Down markets in particular can represent really good times for rebalancing, but it might feel uncomfortable to sell some of your assets that have been doing okay and buy the unpopular ones. I personally remember coaching clients through the Great Recession of 2007 to 2009, when the S&P 500 fell roughly 60% over the course of 17 or 18 months. And at some point or another, most people had a hard time with the idea of selling bonds that were doing relatively well to buy stocks at a time when the outlook for the economy was pretty dire and offered very little signs for improvement. And think about it. If you rebalanced on a quarterly basis during that recession, you might have bought when stocks were down 10%, and then again when they were down 20%, then 30%, then 40%, etc. In my opinion, that's part of why you hire an advisor. They do those tough things without emotion. And same goes for the spring of 2020 when the pandemic began and the S&P 500 fell by over 30% in about a month. Not only were people wrestling with the fast-paced bear market, but there was this health scare that made the situation seem so much different than past bear markets. There was so much we didn't know when rebalancing in March or April of 2020, but those that were disciplined and rebalanced were handsomely rewarded with the rip-roaring rally of the past 12 plus months. In both instances, the financial crisis and the pandemic, those who did rebalance were best positioned to capture the available returns during the subsequent recovery. But at the time, it represented a pretty big leap of faith in the academic evidence that our capital markets would probably prevail. On the other side of the coin, rebalancing can be challenging when markets are up because it requires you to sell some of your best performers and rebalance into the relative laggers. And in recent years, this has often meant buying international stocks and emerging market stocks at a time when the S&P 500 is basically crushing everything. And in the moment, it can feel counterintuitive. But again, disciplined rebalancing offers a rational approach to securing some of your past gains, managing your future risk exposure, and remaining invested as planned for capturing future expected gains over the long run. Now, besides combating your emotions, I mentioned there's some trade-offs that have to be considered. If trading were free, you could rebalance your portfolio every day with a ton of precision. But in reality, trading incurs fees and potential tax liabilities. So we're trying to achieve a reasonable middle ground. And to do so, it's best to have guidelines for when and how to cost-effectively rebalance. Most rebalancing strategies, they fall into one of two categories. The first is time-based rules to rebalance a portfolio, which is rebalancing on a predetermined interval, whether that's daily, which is probably excessive, monthly, quarterly, annually, etc. The other category is threshold rebalancing, which means predetermining the percentage drift from a target allocation that would trigger a rebalancing. And in this case, you could choose to rebalance the portfolio immediately when it drifts, say, 10% from its target. A lot of threshold strategies look at some predetermined interval, like look at the portfolio quarterly or annually or monthly. And if it's outside the drift, you rebalance rather than triggering at any given moment when it's outside that drift. And which is better? I mean, I've done this project a couple times in my career now, and every time I feel pretty discouraged with my results that are simply, it depends on the time period being measured. On one hand, more frequent rebalancing keeps a portfolio more closely aligned with its allocation targets. But the potential downside is that premature selling of winning positions to buy laggards can hinder performance more than less frequent rebalancing would. More frequent rebalancing also triggers more taxes. And if you think about it, this makes sense. In a taxable account, capital gains are realized whenever a security is sold for a profit, which is likely to happen with rebalancing since you are systematically trimming positions that have grown within your portfolio. And of course, taxes are just one of the costs to rebalancing. The other costs come in the form of time and trading fees. Now, if you have an advisor, the time consideration is not an issue because you're paying someone to take that off your plate. But the explicit and implicit transaction costs incurred by trading mutual funds and ETFs. And no, your free ETF trades are not actually free, but that's a different topic for another day. These costs, explicit and implicit, they really add up quickly if you rebalance too frequently. YCharts, which is a data provider, recently issued a white paper that I will link to in the show notes. Typically, YCharts requires a subscription, but I have a special link here that you can use to access the paper. And the paper examines how 6 different rebalancing strategies affected portfolio performance and risk over 25 years of history. So this includes 4 bull markets, 3 bear markets. The special link in the show notes at thelongterminvestor.com will let you access that paper for free. So go check it out. The portfolios that they have in that study have 6 positions that make up a globally diversified 60-40 index portfolio. And the 6 strategies that they evaluate are monthly rebalancing, quarterly rebalancing, annual rebalancing, a 5% drift, a 10% drift, and a portfolio where there's never any rebalancing. And for the 25 years that YCharts studied, the frequencies of trading, they vary a lot. So if you monthly rebalance for 25 years, that's 300 sets of trades. Now, remember, if you have more funds, that's going to be way more trades. That 300 comes out to 12 rebalances per year. Look, there's 12 months. I don't have to explain that math. That's pretty easy. Same with the quarterly rebalance. Over the course of 25 years, that means 100 rebalances or 4 rebalances a year. 25 years, the annual rebalance has 25 rebalances over the course of 25 years. Pretty intuitive. The 5% drift. That's when the portfolio drifts 5 percentage points from its target allocations. And over 25 years, that happened 25 times. So that comes out to 1 rebalance a year. The 10% drift rebalance, that happened 7 times in 25 years. So you're not rebalancing every year, which maybe could be a benefit depending on your situation. Whether it's the YCharts study or a number of other studies that have been published, you might be surprised to learn that the differences in rebalancing strategy is actually not all that important as long as the rebalancing rule is consistently adhered to. So one concept the YCharts paper explores is changing the rebalancing strategy based on the type of market you are in. And this is a concept I pretty firmly disagree with because it requires that you, 1, know that you're entering a bear market or a bull market, which is extremely difficult to discern in the moment. And all rebalancing studies are with the benefit of hindsight. So yes, obviously it'd be best to rebalance less frequently in a bull market and less frequently in a bear market, but you can't know that in advance. Secondly, the frequency or threshold you choose for rebalancing is secondary to establishing the systematic rebalancing strategy in the first place. You want to set a policy that's going to trigger rebalancing events in a consistent manner, ideally balancing the needs for keeping your allocation in check and limiting the higher taxes associated with more frequent rebalancing and turnover. And whether the rebalancing rules you set outperform will be a matter of complete and random time period luck. And when it comes to rebalancing strategies, the best strategies, again, are only going to be known with the benefit of hindsight. But here's what we definitively know. We know that a rebalanced portfolio generally exhibits a tighter return distribution than a portfolio that isn't rebalanced. We know that non-rebalanced portfolios generally are more volatile. We know that rebalanced portfolios typically earn more return per unit of risk, which asset allocators often refer to as they have better risk-adjusted returns. We know that emotionally, rebalance can help with the discipline and emotional control in those really volatile markets, which means it's easier to stay on track. And the most important thing for the long-term investor is to stay the course. And finally, and I'm getting a little repetitive here though, any rebalancing strategy is better than no rebalancing strategy at all. There's another rebalancing strategy that it's a bit more technical, but I'm going to put it in the show notes. It comes from Vanguard. And Vanguard has a lot of great research. Look, when you manage over $5 trillion, sure, they're low cost, but low cost on $5 trillion is still a lot of money to spend on good research for us all. There's a quote that I like at the end of the paper. Quote, "Ultimately, we believe that investors will benefit from systematic rebalancing, but we don't find a specific rebalancing threshold or frequency that consistently outperforms other forms of rebalancing. It may behoove investors not to stress about the specifics, but rather to choose a rebalancing strategy they can comfortably stick with." End quote. So the most important thing is to have a rebalancing strategy and stick to it. But the final thing I think we can think about as we're looking at different ways to rebalance is how do we do so in a tax-efficient manner? I think there are 5 ways that we implement that you ought to consider. The first is just to focus on tax-advantaged accounts. Obviously, rebalancing within tax-advantaged accounts like an IRA is tax-free. In the Vanguard study I referenced just earlier, it found that applying this tactic increased after-tax returns by 44 basis points, or 0.44%, on an annualized basis without increasing risk exposure. So this one seems like a no-brainer. Of course, it works best when you have a mix of asset classes in your tax-advantaged account, so that's something to take into consideration as well. The second thing is when you're rebalancing in taxable accounts, you want to focus on targeting specific tax lots. So when you go to sell a mutual fund or an ETF, if you've been adding to it over time, your cost basis differs because you're buying at different points. And so you want to sell the shares that have the higher cost basis so that you have the lower capital gain. Third, rebalance with portfolio cash flows. So if you're directing cash inflows, such as a lump sum investment or dividends or interest into your portfolio's underweighted asset class, that's another way to naturally rebalance without creating additional transactions, additional tax fees. This can also really be accomplished on the withdrawal side too, if you think about it, such that when you start liquidating, you start with the overweighted asset classes first to generate the cash to meet your lifestyle needs. Now, most people, they're either saving, they're in that accumulation phase of their life, or they're withdrawing, they're in the decumulation phase. So this type of rebalancing is pretty practical. I think it plays an essential role in our methods to rebalance in a tax-efficient manner. And I think when possible, it helps if the savings and or the withdrawals are predetermined, because otherwise you might fall into that trap of market timing that rebalancing is supposed to avoid. So when you have savings, making those deposits, whether it is once a year or monthly or quarterly, or maybe every couple of years or right when a bonus is paid out, have a plan for when you're going to deposit it, because that's when you're going to then allocate it across asset classes such that it rebalances you back to the target allocation. And for those of you who are retired but not spending down from your portfolio, at age 72, you're required to take minimum distributions from your IRA. So that's another opportunity to do so in the context of rebalancing in a manner that'll be advantageous today and in the future as well from a tax perspective. A fourth consideration is that you can rebalance to within the drift tolerance bands rather than back to the target allocations. This is particularly effective for minimizing transaction costs and taxes, because if you opt to rebalance your portfolio partially to your target asset allocation, you can focus more on the asset classes that are extremely overweight or underweight and limit the taxes and transaction costs associated with a perfect rebalancing back to the decimal point of your target allocations. It can be a little bit difficult to quantify the trade-off between avoiding transaction costs and taxes and marginally approaching your target asset allocation. So it's really important that when possible to make rules-based decisions if you're implementing this technique. It also, again, helps to rebalance first with the higher basis shares to improve that after-tax return within the portfolio. And typically that doesn't impact risk exposure positively or negatively. And then finally, if you're charitably inclined, you can gift shares from your taxable account or take qualified charitable distributions from your IRAs to maximize the tax benefits while rebalancing. When gifting from non-retirement accounts, focus on the low basis shares in lieu of gifting cash, because doing so means you're not going to owe any capital gains tax on the appreciation on the holding, and because the taxable basis carries over to the donee, and they don't have to realize that because they're a nonprofit. Little housekeeping before we wrap up today. Rather than tackling a single question at the end of each episode that doesn't necessarily relate to the topic being covered, I think I'm going to try out compiling multiple questions into the occasional mailbag episode. So keep submitting your questions on thelongterminvestor.com. You can also submit them to me via email. And if you're enjoying the show, please subscribe and leave me a review. I'm reading every one of these reviews, and I really appreciate all you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.